What is going on? Welcome to my channel. I'm the Covered Call Guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income using Covered Call ETFs. Right now, my projected annual dividend slash options income is about $82,000 a year, 6.8K a month, 1.5K a week, $226 a day, and about $9.42 per hour. Legal disclaimer before I start this video: this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I'm just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, today's video is again on the great NEOS. Okay, everybody's loving the NEOS, so hopefully they're putting out some great products such as this boosted. Everybody is looking forward to. Okay, it looks like everyone was anticipating it. So we're going to be talking about the NEOS Boosted ETF, the new income revolution. Again, I'm just disclaimer here, I could be wrong until new info does come out, until it actually does come out, but I try to get everything from the perspective and just running through the scenarios here. So we're going to be talking about XSPI, XQQI, and XBCI, right? The expected launch date, I think it's confirmed, is February 3rd, 2026. All right. All right, so what does boosted really mean? We're going to get down to the bottom of it, right? We're going to talk to the basics. The structural evolution, my friends, let me tell you, these ETF are designed to solve the primary defect of traditional covered call funds, which caps the upside potential. Right now, these boosted ETFs have a 1.5x exposure, meaning they're engineering a 150% gross exposure to the underlying asset, right? NEOS aims to deliver high monthly income while retaining the ability to participate in market rallies. I think right now, I could be wrong, correct me if I'm wrong, what I'm finding is the management fee is about 0.98%. So, if you're willing to pay that and your goal is to solve the cap effect forever, then it works out for you. All right, the objective, aggressive income, is what I'm getting from this, right? Listen carefully, because unlike defensive buffers like JEPI, if you do own JEPI, or pure yield traps like QYLD, right? XSPI, XQQI, and XBCI, or aggressive instruments here, right? The total return enhancement, right? They're aiming for growth, not just cash. Income maximization, right? They're targeting about 15 to 8% annualized for equities. The trade-off, you have to be willing to accept higher volatility and deeper drawdowns than the broad market. All right, so if you're new, I would say stand by. Don't just get your foot wet and jump in. For those who are a little bit more experienced and have a little bit more tolerant, hey, it might be something you're looking forward to, right? I'm gonna say again, the warning here is not for timid investors. Let's look how it would do in a bull versus bear market, right? When does it shine? Again, guys, these are my scenarios. I could be wrong. I just kind of run through the formula here and just plug things in and out. All right, so my scenario in a raging bull market is 100% outperform. It is designed to absolutely dominate in a raging bull market because it has a 1.5x leverage offset call drags. And a sideways and grinding, I would still say it outperforms, right? High premiums plus leverage drift equals the nice sweet spot. That's where we want it to be. Right, and then the bear and a crash, of course, this one would definitely underperform. Like I said, if you're new, what comes after, leverage, right? Liquidation, right? So the leverage magnifies the drop. As much as you want to go to the moon, it will drag you back down, right? So how did I come to these scenarios? Well, the math behind the moves here, right? We're going to break it down, the mechanics of the 1.5x multiplier, right? So in a plus 10 market year, my exposure aims for plus 15%, right? Minus the call options I sold, I still win big. In a flat year, I collect the fat premiums while standard index holders get nothing. This is why this is the sweet spot. And of course, in a crash, right? Negative 20%, my fund drops negative 30% or approximately, right? I must be prepared to buy the dip because the hole is deeper. So if you're going to get into something like this, you have to be committed to buying the lows. My verdict here, you're going to shine in a bull in a flat, but lag in a crash. All right, what's underneath the hood, right? The 150% engine. I don't think they're using any margin debt. And that's right. I don't think so, right? The boosted part exposure is not achieved via margin debt, which I like. Very good. It does, however, of course, has to use a synthetic option strategy, right? So the synthetic formula, so to speak, plain English, call minus put equals a stock exposure. We buy calls plus sell puts at the same strike to create a synthetic long, right? Of course, they're going to probably use collateral, right? Cash invested in T-bills and stock. And then the reset monthly option reduced the volatility decay compared to the daily 3x ETFs. So capital efficiency at its finest. I'm expecting great things from NEOS like always. So I don't have any real concerns about it right now. All right, the yield engine. Is it done right? We have to look into three separate parts here. One is the 150% coverage, right? So they're going to be writing calls on the full 100%, 150% nominal value. This creates a massive yield engine bigger than standard funds. Second, it leads to the monthly out of the money calls, right? So they're known for, NEOS is kind of known for this, right? Calls are written out of the money, OTM. And because we have 1.5x exposure, we can write further out and still hit yield targets. And third is the cash shuttle, right? Options are European style, no risk of your shares being called away early. It's pure cash flow, right? This gives it the edge, wider upside window than competitors. All right, the risk. I talk about the good. Let's talk about the bad, right? The risk report for equities, right? XSPI, which is the underlying of SP 500, right? Replicates the SP 500. It is more diverse. The options overlay is actively managed by Gary and Choi. I love them. I love their interviews. If you guys are new to NEOS, go ahead and watch the interviews. Part of the reason why I love NEOS is it started from the interviews, right? So based on volatility regimes, so they've done a great job so far. And then XQQI is the NASDAQ 100, right? Carries the inherent concentration risk of the Magnificent 7 tech stocks. If tech crashes, right, this crashes even harder, 1.5x harder, given 150% boost, right? So the objection is know what you own. It is high tech beta, so understand that. All right, let's talk about Bitcoin of their boosted XBCI, right? The crypto risk here. The structural risk is that the Cayman subsidiary to comply with laws. XBCI holds crypto via Cayman Island shell companies capped at 25% of the asset. It is the volatility multiplier. If you're bullish on BTC, right, this is the 1.5x leverage on an asset with 60% volatility. So expect wild swings, okay? It does have the road yield trap. So you need to understand this. Bitcoin futures often trade higher than the spot price. So every single month, the fund must sell low expiring contracts and buy high next month for the contracts. A lot of people don't know this. So just know this is part of kind of the strategy here that they really can't escape. The cost, right? So this acts like an invisible expense ratio, potentially eating anywhere, I would say, 5 to 10%, right? Let's not be conservative. If you overshoot, it's always better to know how much of your money you could lose, right? Of the NAV annually during flat markets. My verdict is always going to be for crypto. My verdict is always going to be speculative. I have not gone off that path. I always want people to know if you're into these type of assets, you're speculating, right? So watch the contango trap here. Just know what you're buying when you're buying crypto. All right, I want to mention NEOS has changed their payout. They have now gone, quote unquote, I like the way they're doing this. I see this as the weekly paycheck ecosystem, right? So NEOS has reorganized their entire lineup. You can now stagger your holdings to get paid every single week. And that is very enticing to me. I am starting to really now, I don't know. I talk about a lot of other things and other stock and ETFs, but now I'm starting to think, wait, why not actually just start lining up my ETFs with NEOS? Yes, there is a concentration risk with NEOS itself, but I think I'm going to start owning one ETF of NEOS for every single week. So I get 4 paychecks per month. It's kind of like I'm getting paid weekly, right? So my goal here is continuous cash flow once per week at least. Let's take a look. Week 1 and 2, growth and safety. Week 1, is the payout of the boosted XSPI, XQQI, and XBCI. These are the boosted high income, right, aggressive 1.5x exposure. For week 2 is the fixed income of CSHI, TLTI, and BNDI. These are the enhanced fixed income, safety, and yield of about 5 to 6%. The strategy is start aggressive, stabilize mid-month. Does it sound good? I hope you like starting with the strategy, because I'm starting to look into this too. So if you just found this out from my video, let me know what your strategy is, because this is starting to get very interesting. All right, I might not even need Maggie anymore. I'm really starting to think, all right, maybe I can put that $60,000 into something else. Weeks 3 and 4, the core and hedge, right? Week 3, they shift SPI, QQI, IWMI from the first week to the third week, right? So these are the core high income, right? Unleveraged equities, giving you about anywhere from 10 to 14%. And then week 4 is the hedge. QQH and SPI-H are the hedge equity income, right? These are the defensive puts. The strategy here is core holdings followed by downside protection. So you guys kind of see where I'm starting off, right? I got the aggressive week 1. All right, hopefully week 1 I can get paid out decently. No, then I can go to week 2 and I can kind of at least get my estimated. That way bills are paid. Week 3 is my core. I know it's pretty much I'm gonna get paid about the same amount. And then week 4 is the hedge, followed by downside protection. If the month does end terribly, I do have some buffer there. So I'm starting to see the my portfolio build here. So I am starting to map out and see if I could get one ETF each week from NEOS. Hey, my strategy changes every single time these new strategies does come out, right? So and that way I'm adapting. So if you're like, oh, why are you kind of switching back and forth? Remember guys, investing is not a group project, right? What works for me might not work for you. So you might see me do these things, you're like, man, this guy is crazy, what is he doing? Well, the way I'm trying to set myself up is I want to get paid at least once per week without relying on weeklies, because I think so, monthly payers are just a little bit more stable. All right, so let's talk about the tax alpha, right, of section 1256, because this is huge, right? I don't want to be paying taxes, right? NEOS uses index options on the SPX and NDX, right? So these qualify for the section 1256 tax treatment, which just means if you're new to this, new to my channel, new to NEOS, new to income investing, it just means you have 60% long-term rates plus a 40% short-term rate, right? So plus they use tax loss harvesting to classify some distribution as return of capital, deferring your taxes, right? So the reality is it keeps about 10% more of your money versus the peers competitors. All right, let's talk about upside and downside, right? I always try to be truthful with you guys, right? So we always have to talk about the leverage reality, right? The upside in strong bull markets, XSPI and XQQI should outperform unleveraged peers like SPI, right? Of course, come on, it's a given. That's the whole reason why you get into the leverage here. The drag though, if the market rises too fast, the call drag acts as a parachute. And then, of course, in a crash and a 20% drop, expect even close to a 30% NAV decline. So if you're starting at, an easy number, like let's just say $10, well, expect to lose, a full $3 of the share going down, right? Now, it gets you even close to zero. So it is kind of scary in that sense, okay? And then we got to talk about the recovery trap. Do not ignore the math of losses, right? If my fund drops 30%, that means I need a 43% gain just to break even, right? This is the 1.5x, the 1.5x leverage helps me climb out faster, but the hole is deeper to begin with. A lot of people just see the upside, but not the downside and the recovery to the upside, okay? My verdict is high risk, high reward. Are you in or out? Right, solving the NAV erosion, right? So the old problem that this really does solve is for those who like QYOD. I haven't met anyone who does. Maybe there's a new viewer, subscriber that does like it. I don't know. I'm not a hater. Welcome to the channel. but I personally haven't met anyone that actually like QYLD yet, right? So what is it? It's just a standard fund that caps upside while taking full downside, right? So this leads to a ratchet down effect where NAV never recovers, and go check it out yourself, right? The NEOS solution, how I see these boosted ETF, is that by capturing 1.5x of the recovery, the fund mathematically has a better chance of repairing NAV after a drawdown than a regular 1.x fund, right? And then the goal here, income that doesn't eat your principal, because we never want that. I talk about it on this channel, but I will never steer you that way to entice you to kind of and quote unquote invest. For though, if you invest in something like that, it's more in gambling. All right, the cost of business. Like I said, I think the actual expense ratio is 0.98%. Correct me if I'm wrong. That's the information I found, right? It is very high compared to passive funds of 0.03% for a reason, right? But standard for more sophisticated alternatives, implicit costs, right? So you must account for the cost of carry. Okay, people don't factor that in. That is pretty much, it eats away at your gains, right? Embedded in synthetic leverage, effectively the risk-free rate, about 4 to 5%. This is an invisible drag, right? And of course, trading. As new fund launching February 3rd, 2026, liquidity is low. So I would say use limit orders so you don't end up buying at a price it's not favorable, right? You pay for the engineering, so limit your orders. All right, so who's flying the plane? I think I've mentioned this, right? The team is managed by NEOS Investment Management, Garrett, I don't know how to say it, Garrett and Troy Cates. I love their interviews. If you guys haven't seen the interviews, go YouTube it. I believe Income Architect was the one that interviewed them and kind of solidified my opinion and my choice in my investment thesis in NEOS. So I always watch all of their interviews. And then track record, right? So these guys are the pioneers. Come on, right? NEOS. They've been playing the game for a while now, and they're absolutely destroying all of their competitors, right? They built SPI and QQI, gathering billions in asset under management by delivering stable, tax efficient yields, right? My verdict here is proven hands on the wheel. I am very, very I'm expecting for them to gear these boosted ETFs in the right direction and actually be sustainable compared to a lot of other boosted or leverage ETFs. All right, let's look at, I always like to do comparisons, right? NEOS versus QYLD, the legacy. Of course, I mentioned it's from QYLD, it's from Global X, right? They're right at the money call on 100% of the portfolio, which caps all upside, right? The flaw, it's a decaying annuity, right? If market drops 10% and rallies 10, QYLD takes the drop but misses the rally, right? NEOS XQQI uses 1.5x leverage plus out the money calls, so it captures the recovery, right? There's absolutely no justification reasons to hold QYLD over NEOS. My winner, NEOS by a mile. NEOS versus YieldMax, right? You're gambling here for the most part with YieldMax. Right? I'm not gonna say every single one, but maybe like 3 or 4 of YieldMax ETF or stock is doing very well. But we're going to just compare it to MISTI and NVDY, right? Synthetic single stock exposure. If Tesla has a bad quarter, ETFs collapse. I say this a lot, right? Tax disaster, right? Single stock options are mostly, for the most part, ordinary income up to 37% tax. I don't think there is, for the most part, no section 1256. So NEOS is diversified SP 500, eliminates single company blow-up, right? My verdict here, NEOS is for casinos and YieldMax is for casinos and NEOS is for the wealth. Right, NEOS versus JEPI, right? JEPI is considered the shield, a little bit more defensive, right? So we're just gonna compare the rows, tax, and fit. For NEOS, the rows here is offensive, the tax is section 1256, and the fit is a bull market. For JEPI, the row is defensive, tax is ordinary income, and the fit is a bear market, right? My verdict is it kind of complements each other. They're not really rivals. I would say you could own both. All right, NEOS versus TDAC, right? The daily beast here, right? So Tap Alpha TDAC uses daily out the money calls on QQ ETF, right? The flaw here is that it does cap upside every single day and misses, for the most part, I would say, the gap up. I know some of you guys did mention the changes, but I still think mathematically the strategy is it still would miss the gap ups, okay? and it could lead to the tax trap, right? Uses ETF options, which I believe is ordinary income, right? NEOS uses a more tax efficient section 1256. The math here, I think NEOS does offer a more about 10% higher after tax purely due to structure, right? I think NEOS XQQI, if you want to do the QQ, I think NEOS XQQI it beats it just based on the superior math and strategy behind it. All right, my final verdict. Should you buy now or wait? Okay, if you are divided into the two groups, if you are the conservative investor, I would say wait 3 to 6 months. Yes, wait. Verify the complex 1.5x tracking works and the yield stabilize. If you have the time, just wait and watch. For the most part, I don't think NEOS is a gimmick, right? However, these boosted ETFs don't exactly have a good track record. Let NEOS do its thing. I'm sure they will, find a way to maximize and actually sustain the strategy. But we gotta always ask ourselves, is this a gimmick, right? As much as I love NEOS, we gotta ask ourselves, is NEOS putting this stuff out just because there's a trend for it, right? Oh, everybody's chasing this. So just wait, sit back, let NEOS do its thing. Let the market maybe there's a bear market, it comes out and there's a bear market. You might buy at a great price then. Dabble in it and then see how it performs as a recovery. If I'm right, it should recover decently well, and if it does, then you have seen it in a bear market and a bull market. Then you can kind of like, okay, I give it at least 3 to 6 months. I'm in. For the aggressive bulls, maybe someone like myself, who I am in my early 30s, I might have the time to be okay. You know what? I have the time to kind of let it do its thing. Whether it goes up, goes down, I can still buy into it, right? The 1.5x leverage offers an immediate way to capitalize on market recovery while getting paid to wait. So if the market drops while I enter, I can dollar cost average, and then I can go, okay, I'm at a position, perhaps 10, 20, 30 grand in, and I can go, I'm good. I'm gonna let it do its thing, right? So if you're a little bit more aggressive, have some time on your side, then you can go and kind of nibble. For me, nibbling might be anywhere from $1,000 to 30 grand all at once, right? It's just don't follow my path. I know there are people in the comment section that goes, oh man, why'd you do this? Now it's making me question. Remember, investing is not a group project, right? I can be used as an example here, right? You see me doing something and it works, and what I'm saying in these videos, oh, it actually it's coming true. Then you might want to go ahead and dabble because you already want to buy it. But if you were hesitant and I got in, I said, you know what, this might not be a good buy, but I'm gonna check it out, and it might not be a good buy. Then you have your kind of like, oh, you solved your thesis was true, right? And then of course the liquidity warning here is that this is going to be a new launch. I think it's coming out February 3rd. That's what I find. So for those who are new, follow these rules, right? Never use market orders. Use a limit order. Avoid trading in the first 30 minutes of market open, right? Let spreads settle. And dollar cost average. Dollar cost average to smooth out your entry volatility, and dollar cost average is always your friend. If you have high conviction, your investment if it follows your investment thesis, and you know it's a great stock or ETF, it would make sense to dollar cost average. Okay. Thanks for watching, guys. Let me know if I missed anything. Let me know in the comments. Rip me apart and fact check me. I try to really double down on the information, but again, this is not even out yet. I can only go on the perspective and kind of guess on how it would perform on the 150% boosted, just based on SPI and QQI and BTCI. So if you found this video interesting, if you found it informative, creative, funny, If you liked it, didn't like it, still please give me a like, subscribe, and leave a comment. I always appreciate every single one. I do my best to reply to everybody. And if I missed you, again, leave a comment on all my other videos because I will try to do my best to answer questions. If you have a video topic you want answered, leave it in the comments. And if I missed it, again, guys, I do not consider it spam. It actually makes me feel very warmed, and I see the appreciation when you guys are constantly leaving topics for me to cover, and I really appreciate that. Shout out to everyone who does that for me. You guys are the true MVP. All right, catch you guys on the next. Thanks for watching. Stay tuned.